Hello, students. So here we have to begin class 11, Accountancy, and the first chapter we begin with. It is called Meaning, Objectives, Scope, and Nature of Accounting. Now, when I talk of the term accounting, we all have a generalized view of this term. When I talk about accounting, it will mean for some of us, it is a systematic way of writing down things, or keeping a record of things, or telling this information to somebody, showing this information to somebody when it's required by them. So normally we think of this term in terms of a business. Now let's understand this a little more in detail. Accounting is done by business people or people who are in business for the sake of writing or recording down their transactions. And they record it in one place. The recording is done in the books of accounts. You call them the books of accounts. Earlier, many years back, when people used to do business, they used to write them down in actual books. Nowadays, it is done on computers. Okay. So you keep a record of every transaction or every event that has occurred in business in a book or on the computer. In our syllabus, we have the last few chapters which are about computerized accounting. Although we will not study them, we will only be concentrating on a way of preparing the proper books of accounting in our syllabus. So let's understand why we need to do this accounting. So in general, we need to do this accounting for the purpose of finding out our profits in the business. This is one reason. Which other reason we may require it for? To keep a record of our transactions in business. This is a second need for doing accounting. So just keep these in mind. We'll work out further things a little later on in this chapter. For now, these two purposes that I mentioned here, this is just for you to understand why we do accounting. And we'll add on to this later on. Now, any kind of accounting that is done has a series of steps. We're going to discuss what steps are involved in the process of accounting. And later we'll define accounting as well after we go through that process. So the process of accounting this involves a series of steps. What are those steps? The first of them is identification of business transactions. So what are business transactions? Any transaction which is relevant to the business is known as a business transaction. Now, if I make you understand, let's take an example of us wanting to withdraw money. We are doing business. This is our office. And this is the ATM. We want money for our office purpose. So we send one person to the ATM. He brings back the money and he gives it in the office. So is this a business transaction? What is happening? Here you can see that initially, suppose we assumed we had no money in the office. So initially the cash was it was 0. Now suppose he is withdrawn 10,000 rupees. So now the cash which we have in office has become 10,000 rupees. So withdrawing money involves a series of steps. What were those steps? The first thing is to send one person. He went to the ATM. Maybe he went by his bike. Maybe he went walking to the ATM and he withdrew the money and he came back. So you see, there are a number of steps involved. There are a number of transactions that are involved. There are a number of events that are involved in this whole process. But what is the actual process we are thinking about? We are talking about business transaction. So which is that transaction which was relevant to us? The one in which he came and he gave us the cash. So what happened when he gave us the cash? Cash increased. Initially it was 0 and later on it became 10,000. So we have to identify whether a transaction is a business transaction or it is not a business transaction. So out of these series of steps that I just defined in this over here, in this example, we only have one that is involving us to get cash in the business, and that is our business transaction. All right. We go on to the second step or the second stage. The second stage in the process of accounting is measurement in monetary terms. So we saw, first we took out transactions which were relevant to the business. Now we are going to measure those transactions and see if they are measurable in terms of money. So accounting would involve only business transactions that deal in money. Okay, business transactions, or I can say business events, any of these terms which deal in money. So accounting, as we know, it is a systematic way and we write down all the transactions that are taking place. Here this principle or this process is saying we are actually going to see those transactions of a business which are in monetary terms. Okay, so accounting would involve only business transactions that deal in money. For example, if one worker is not working up to the mark, up to the mark means he's not working well in a business. Now think about this. This is an example which I'm giving. I'm saying one worker is not working up to the mark in a business. Now, is this a monetary transaction? I don't think this is a monetary transaction. It is a business transaction because it is saying that this worker is working in the business, but it's not a monetary transaction. It is not a monetary transaction. It is a business transaction though. As it is relevant to the business, but it is not a monetary transaction because it's just a statement. We are saying one worker is not working properly. All right. So this, whenever we talk about accounting, we would always talk about transactions. The first thing is that they should be business transactions. Second thing is that they should be able to be measured in terms of money. All right. Now the third point. The third is recording of business transactions. Okay, so what does this mean? We are going to record business transactions. Whenever I use the term recording, it means write down. So you're going to write down all the business transactions. So the third step in the process of accounting is to write down all your business transactions. Now, what are the advantages of writing down business transactions? Because we forget. So it keeps a record, a record. Else we forget. So accounting involves recording of business transactions which are financial or which are monetary in nature. And we do that because it helps keep a record, otherwise we would forget them. There are so many business transactions which may occur in a business. Maybe in a month we have 100 transactions. So in a year we may have more than 1,000, more than maybe 1,500, 5,000 transactions, because we'll be purchasing so many items in a business, we'll be selling so many items in a business. So we'll have money coming in, money going out of the business, and we'll see that in some time. Next, the fourth of them, this is called classification of business transactions. Okay, now when I say classification, let's understand this. If I give you some example of a business transaction, let's say the first example which I give you is purchase of raw materials worth 10,000 rupees. The second, purchase of furniture worth 10,000 rupees. And the third, sale of goods worth 5,000 rupees. Now, let's understand these transactions. When I say purchase of raw materials worth 10,000 is done by the business, the meaning of this implies initially my raw materials were zero. I have purchased it and it's become worth, on purchase it has become worth 10,000 rupees. Okay. If I talk about the second transaction, it says purchase of furniture worth 10,000. So this implies initially my furniture, which is an asset for me, was zero. I did not have any furniture earlier, and now on purchasing this, it has become 10,000 rupees worth of furniture that I own. If I talk about the sale of goods worth 5,000, this implies initially my sales were zero, and later on it became equal to 5,000 rupees worth of sales. Now let's understand this a little more. The first transaction which I'm talking about, I am saying purchase of raw materials worth 10,000. So when I purchase raw materials, maybe I'm paying it in cash. So over here, I will even talk about cash. Cash with me was 10,000 rupees earlier. Now cash is reduced to 0. If I spoke about furniture, earlier I did not have any furniture. Then I bought furniture worth 10,000 rupees. So furniture now became worth 10,000. So say I paid for this also. So cash, initially I must have had 10,000 rupees lying for purchasing furniture. And when I paid this, it became 0. Okay, that has gone away. And when I did sales, say when I did sales, I got money. So initially my cash, let's say I had 0 cash, and now on doing the sale of 5,000 rupees has come back to me from the person who has bought my goods. So it has become 5,000. Okay, now what is happening? You can see that in this case we have seen that one item is either increasing. Over here when we purchase raw materials, earlier we did not have any raw materials and now it has become 10,000, whereas the cash which we paid for the purchase of the raw materials, it has gone. Earlier we had 10,000 rupees cash with us, but now on paying for that, 10,000 rupees has gone and this has become 0. The second transaction, furniture, we did not have anything. Then we purchased some furniture worth 10,000 rupees. So the furniture came to become worth 10,000 rupees and we paid cash of 10,000. So cash is also gone out. In the third case, we had sales to be 0 earlier, but we sold goods worth 5,000. So our sales have become 5,000 now. Whereas our cash on selling goods, initially it was 0, but on selling the goods, it became that we got cash of 5,000. So we will always see that there is an increase in one and a decrease in the other, or there are at least two accounts which are involved. So when I'm talking about these transactions, every transaction will involve at least two accounts. The first transaction here is involving a purchase account. First transaction is involving a purchase account. You have to remember this just now. We'll understand this in the next few chapters. So here I'm just telling you this is involving a purchase account and a cash account. So this is the second. In the second transaction, we are involving a furniture or an asset account and we are involving a cash account. In the third transaction, we are involving a sales account and we are involving a cash account. Okay, so all these are seen that we have different accounts. Now, you can see purchase account is the first account mentioned here. Furniture account, let's assume this is the second account. Sales account, let's assume this is the third account. Cash account is here, so let's call it the fourth one. Cash account is here, so again let's call it the fourth one. Cash account is here also, so this is also the fourth. Now what is happening? This is just 3 transactions which I've given you on this particular day. In this month, you may have so many transactions. So you may have so many within purchase account. You may have so many to be written within furniture or the asset account. You may have so many to be written within the sales account. And in these 3 transactions itself, you are seeing there are 3 places where we have written cash. So if I write all of them at one place, in accounts, we write all these in one place, all the transactions related to a particular account in one place. So for my purchase account, I will make something like this. I will put a heading on top over this and I will create an account. This is how an account looks. We will see it more in detail later on. Then for the furniture account, I'll create something like this. And for the sales account, we'll create another one. Even for the cash account, let's create another one. Okay, so we are doing what? All our transactions we are classifying. We are writing our purchases in one place over here in this purchases account. We are writing our furniture transactions in the furniture account. We are writing our sales transactions in our sales account. We are writing our cash transactions in our cash account. So this is known as classification. So accounting has 7 steps, and this is the 4th step, which is called classification of business transactions. And in this stage, we classify the transactions and we put them into different accounts. All right, let's move to the next. Next is called summarizing, the 5th one. Summarizing of business transactions. So summarizing means we are writing a summary of business transactions. The name of this heading itself is saying summarizing business transactions. So how do we summarize our transactions? Sometime back we saw classification where we saw, say, the purchase account. So the purchase account, I told you, looks like this. It will have this line in between, and these are two sides of it. So say on the 1st of April 2023, I have written some value here. Say this is 5,000 on, and something else. For what this 5,000 is, I'm not writing over here, whatever this may be for. I'm just showing this. Then for 10th of April 2023, I have 10,000 written over here, and so on and so forth. So the full year's transactions are written in this account. Now, summarizing means to actually tell you a summary. So where do we get the summary? We get it in the total. So purchases account, when we make, we get a total figure over here. Okay. So this figure that we are getting, this totaling that we are doing, this is telling us that we have summarized this full account and we are getting a balance at one of these places, either on the left hand side or on the right hand side. Okay. So this will give us some information which is actually a summary of that account. So whatever side we may find this, we will see later on. Whatever side this balance will come, which I've circled and kept, whichever side it is supposed to come, that is actually giving us some information. This information is relevant and this process of getting this balance is summarizing. Okay, so this is the 5th stage in this process of accounting. Let's go to the next. The next of them, which is the 6th stage, analysis of business transactions. Now, who does an analysis of business transactions? We are talking of a business. So in a business, we will have many people working, one owner or maybe many owners in the business running that business. So we will have some people doing the job of analyzing this accounting information. Maybe in this business that we are talking about, there is a chartered accountant. Now, what is the information that this person will find out through the business transactions, through all that we have done up till this stage? This person will find out maybe what are the assets in the business. When I say assets, just imagine furniture. Gave an example of this sometime back. What are the assets in the business? How much cash is there in office? How much cash is there in the bank account of the business? Every business maintains a bank account also. So how much cash you have lying over there? How much money has to be paid? Money to be paid to maybe the people who you bought goods from. So maybe to the vendors, you can call them vendors. Okay, so and so on and so forth. So all these are transactions, or all these are the information which you get out of your business transactions, which you have also first the first five stages, which you have already recorded, classified, summarized, and kept. And who finds out this information? Maybe it may be a chartered accountant in the business who is taking care of the transactions or taking care of the accounts in this business. So these people are got specialized skills. They are the people who will study the books of accounts. They will be able to tell all these things and do it correctly and give a clear picture of the business. Now, the next stage is about communicating. So the seventh stage, this is about communication of the information of a business. Now, communication of the information of a business. So the last stage in the process of accounting is communicating the information of a business. So who is this communicated to? This is communicated to the shareholders. Who are shareholders? The people who buy shares in a business. Suppose a business is doing very well. Say we talk about Reliance. It is a business which is doing very well. Sometimes it may be not doing well, but most of the time you see that this is a profitable business. So people buy shares of this company. They invest their money in the business and the business gives them shares. So these people may require to know this information as to how the company is doing, what profit it has made in the year, how much does it manage to make, how much did it manage to purchase goods of, how much did it manage to sell goods of, okay? How much assets does it own, how much money it owes to the people outside the business. All this information shareholders want to know. You also have other people. Who are the other people? The other people are the government. The government requires to know this information because they are concerned with collecting taxes. So if it's a profitable business, the government wants to know how much profit they made so that it can charge the correct amount of tax from them. Who else will require to know? The owners. Owners, why will they require to know how much profit the business has made or how much loss has the business made? Because they would want to improve their business. So suppose next year they analyze all this information. They see how much profit they made in the previous year and how much profit they made 2 years back. They will be able to judge where were their shortcomings, how can they improve their business. So accounting information is required for the owners as well. To the banks, Banks are other people or other organizations which require this information because they give loans to the business. So this information of a business earning profit is going to be useful to a bank because then they can sanction a loan based on the profitability of that business in the past. All right. So these are the 7 stages. The first is identification of business transactions. Second is measurement of business transactions in terms of money. Third is recording of business transactions. Fourth is classification of business transactions. Fifth is summarizing of business transactions. Sixth is analysis of business transactions. And seventh is communicating this information of the business transactions to the users of this information. Now, based on these, we can define this. We can define what accounting is. So let's define it. Accounting is an art of recording, classifying, and summarizing transactions and events which are financial in nature for the purpose of analyzing and interpreting the information to the users. Okay, so let's understand this once more. Accounting is an art. Why is it an art? Because it is a personalized application. How is it a personalized application? Think about this in terms of any person doing his books of accounts or making his books of accounts. Maybe he'll start on the second page of that. Another person, if he's making his books of accounts in his business, he may start on the third page and he may follow his own way, his own method of writing, his own method of leaving space between some transactions, making it as clear as possible, easy to understand. So it is an art because it's a personalized application of a person. So it is an art of recording. This is one of the stages. So it is an art of recording, classifying, summarizing. These are 3 stages. Transactions and events. What are we trying to record, classify, and summarize? All are transactions and events which are financial in nature. Again, one more stage in the process of accounting, the monetary term that we spoke about. And for what purpose? It is for the purpose of analyzing and interpreting, the second last stage, and communicating the information to the users. Analyzing and interpreting to communicate. You can write this also. To, over here we can write communicate. To communicate the information to the users. All right. So this is the definition of accounting. This is the process of accounting that we studied before this. We will continue again, but now we'll stop here. All right. Thank you.